Good morning, SMF, MMTs. We talk about a new trend that has developed in the market. We said over a month ago that it would be a bear trend and that the 2011 top cycle has played its course, as you know. The thing about futures market, as we had talked yesterday in pre-market, this is pre-market futures on 8/10 of 2011 at 5:47 a.m. Pacific Standard Time. How do you like that? And that the amount of buying that happens at market bottoms, when yesterday's bottom was put in, it's a key reversal bottom. You can have several key reversal bottoms within bear trend structures, and the opening in pre-market that the futures start to get. Yesterday the futures were up 200 handles at one time. The Dow futures today are down 130 handles. The S&P is down 15 handles in the futures pre-market, which drops prices. The Nasdaq futures this morning, well, the Dow is down 143 right now, so they're increasingly getting worse. Futures are futures, and when they go down, artificial prices go down. This is where MMTs will look at that left elbow. What we will look at as we go through it is that the amount of futures volatility is where equity prices get higher volatility within their actual weekly trading ranges. And that bear trends on all indexes and bear trends are the best trends to trade. Why? Because you get the higher price volatility from day to day. From being long one day, from being short to the next day, and understanding the progressive volatility increases within pre-market futures is like having a lot of golden eggs being laid. Because what it does is, as we move forward, yesterday's the first good volatility day. That was an increase, and today the gap down, you can see it right here. So the big stocks that made move off their bottoms, like the price lines again and the Googles and whatnot, is that the actual price volatility, and look at the bull, down $3 to TQQ, down, down, down. Now, as we progressively move forward, the key, MMTs, is that when you hit the low today with the left elbow gap down, is that we don't go lower than where the key reversal was in equity names yesterday. And not only that, that the indexes don't go lower, and that each time that they approach those lows is that you get that big knife hook buying that comes in off that bottom. That is the key, and we're going to be training a lot more around the wonderful gifts of bear market trends versus bull trends. And why are bear market trends much more profitable than bull trends? You want to learn more about it? Go to stockmarketfunding.com and sign up and start getting real with yourself. Now, on the flip side, when we go into these things, on the pre-market gap open up, you've got a couple of earnings. You've got the SQQ, which is the other side of the TQQQ. That's the bear. And all bear ETFs are putting consolidation bottoms in, meaning that they broke out, they pull back within the volatility bands, and that the upside of the bull ETFs, you sell short and you're buying the lower end of that trade from day to day to match the roller coaster pre-market gaps. You only have a few things that are open. Creed did its earnings. First Solar had something to say, but look at the gap open up. It's not very much compared to the other day. And the gap open down on the Nasdaq comp is increasing. Google down $6. Price line heavily weighted down $10 in that price line. And that the bear part of the left elbow, when they put that bottom in, what we would be looking at today is what we seen yesterday, is where is that animal spirit of buyers coming in, and are the bears going to cover the short as an exit when they don't go lower? between a bear and a bull fight. And short interest is where you buy to cover and things go higher, and then people come in and how many natural buyers. The machines, the robots, which have been locking latency bids and ask and then dropping very quickly, is people haven't been able to keep up with that. So from day to day, man versus machines, is that the machines take them down, then they roll them right up. And what we seen yesterday was how they were rolling them up on that intraday level. And we would be looking to see that were those machines versus man, that when the stocks hit their left elbow gap down in the SMF platform, that they roll those up. But once they roll them up to the high, the intraday high, then the machines start to work the bids and the ask down. And that is the profound directional movement, is that 75% of it is machines versus humans. And of course your little lovely day trading community and crowds and everyone else don't know that. No, they don't. They're still stuck on the old models out there, and they deserve to get whacked until they get educated correctly. And as far as I'm concerned, I have no sympathy. Let the machines do what they do. But you got to know how to trade what these high frequency volume machines that compute probabilities within milliseconds and locking the latency in the bid and ask, and then a print drops below and or above between the bid and the ask ranges in the level 2s, is how that all works. And how that has increased, so that you know that the majority of what you're trading here is high frequency volume mathematical computing machines. And yo day traders out there, you think you know what you were doing. Hey, I'm sorry, the world has changed. And if you don't change with it, my recommendation is you better stay out of it. Bottom line, left elbow gaps in play, key reversal yesterday, pre-market volatility futures on entries and exits, artificial price drops. When they drop, they hit that lower area in our mathematical platform, right about where them robots are going to turn that trade. That execution must be done quickly. And then to the upside at resistance levels, they will roll down again. And what we're looking at is that you don't see the lows on Apple. You don't see the previous day's lows, that is, of 355. You don't see 3 or 541 on Google today. And as far as key indexes go, they bounce. So when these machines come into play, these high volume frequency machines come into play on that left elbow gap down, when it stops going down, your bid and ask ratio on the SMF platform turns, the IR turns, and they do it quick. And you can't wait, because if you wait, you're going to miss the move. So understanding these left elbow gap downs, and when these artificial machines are going to come in, they're high computing machines. Man cannot keep up with it. Ha, ha, ha. Day trader, be aware. Left elbow gap down, how to trade it, man versus machines, latency in the bid and ask, left elbow hook up with the range and the probability. These machines are going to be working overtime, but the SMF mathematical market maker platform already has them priced in before they even get to those levels of where those turns will be and where they will sell. Left elbow, and how to trade off the bottom, and how to use pre-market volatility in the futures, and how to make some coin.